Welcome back to the 7th episode of the Potato Finance Podcast. I am here with my friend Garrett Steinberg. Garrett, how are we doing today?
Pretty good. It's a nice Saturday.
Yeah, dude. Like I was saying before we got on recording, I really wanted to go to Block Island one of these past 2 days, but unfortunately with our schedules, that this was the best day to do it and just didn't work out. But you know what? You gotta do what you gotta do for the podcast. So really excited to have you on and talk about kind of like your investing strategies and how you really got into investing and all those type of things. But how about to start, you just kind of go into a little bit of detail about yourself. Maybe just talk about like how you got into investing, how we know each other, the strategies you might use. You have the floor. Say whatever you want to say.
Awesome. So me and Josh used to go to the same gym a number of years back. I used to run track, so like I always wanted to stay in shape, but I never was like too much into weightlifting. So then, you know, my gym was kind of one of those like YouTube bodybuilding gyms. So we'd had like we had a lot of people who like lifted and put it on videos, and Josh was kind of into powerlifting, and he would lift like, you know, for me at the time it looked like pretty big numbers, so
It was not.
it made me motivated because, you know, I was kind of driven by numbers, you know, goal oriented. So I figured, you know, if someone could like kind of show me like how to like, you know, what the good form was, like how to like progress my lifts and, you know, feel better about myself, like maybe I could compete. And it was funny, in my, you know, I ended up doing some powerlifting meets, and in my earlier meets, Josh actually coached me through some of them. So
I did.
It was cool to see someone who was kind of like-minded and like interested in like results and kind of like putting in the work. And that was kind of like my foray into investing as well. I mean, I feel, you know, a lot of it, while powerlifting is much different than investing, a lot of it is about like showing up, you know, putting in the works and kind of seeing the results unfold.
Yeah, I think that's a good point. I guess there are some similarities, not just to powerlifting and investing, but really any hobby that you really want to get good at. Like if you want to be a really good stock picker, it's not just going to come overnight, you know? You got to really put in that work and really just stick with it. And it's going to take several years and you just can't get discouraged. Are you still into powerlifting at all?
I have not competed in like 2 or 3 years. I still like lifting with like a barbell. Like I still like deadlift and like squat and bench because I don't know, it's just like what I've known. But I don't like go half as heavy as I used to, and like I don't know, a lot more focused into like golf and like more like recreational sports. So like I don't want to like destroy my body too much, but it's been a good thing for me. Like I've always liked lifting.
Dude, I don't think I've squatted or deadlifted in probably like 2 years. Like I've literally had no desire. I've had like a little bit of a desire to squat again. I've had zero desire to deadlift at all. Like I don't know if I'll ever deadlift again, to be perfectly honest,
Really?
unless I'm just screwing around. Like I mean, I am like so burnt out from the sport. It's like insane.
I mean, I feel like we were definitely mediocre. I'm not like I'm not gonna compare myself to like some of the more elite athletes in the sport. It was cool because I did it when I went to University of Rhode Island. I was on their powerlifting team, and they would sponsor us to go to some national meets. So like I did go to the one collegiate nationals, and like I was in like the 145 weight class. So like I was able to put up like I don't know, like relatively mediocre to decent numbers for my weight class, and I would win like some of the local meets. But then when I went to nationals, I just got absolutely smoked, and then I was just like, all right, I don't think long term I can do this. Like,
Are you still on a program?
I still like it just helps me structure myself. Like I still
That's fair.
write programs, but like I don't like throw in like a ton of like it's more accessories and like more about like just like the reps and sets, like to keep myself structured. Like I wouldn't say like I'm deadlifting like twice a week every week now. Like
That's fair because I feel like even though my goals, I guess, with going to the gym are more just kind of being like overall healthy, I feel like being on a program would help me because sometimes I'll go to the gym and I'll just kind of do whatever, feel it out. And granted, I'm more into like that bro style of lifting, but I don't really have a set structure. So sometimes that leads to me not doing as much as I probably should, or sometimes doing more than I probably should. And it's just like there's a lot of inconsistencies there. So I feel like maybe getting on some sort of like, even I don't know if I do a powerlifting program again, dude. Like, I mean, I'm like so burnt out from the sport, but maybe something, I don't know, maybe like a general fitness program or something like that. I'm much more into like running now, to be perfectly honest. That's really interesting me. I'm more interested in like things where I guess I can really compete in and I guess challenge myself more mentally. Like one thing I'm looking to get into, which I talked about in a recent video, was I kind of want to get into like jiu-jitsu and like martial arts. I'm actually taking my first lesson tomorrow, so I've already taken it by the time you guys are seeing this. But yeah, Matt Downs, he does lessons, and I asked him, I'm like, dude, I'm in kind of like a rut. Like, is there any way, like, I feel like I need a new challenge. Like, is there any way you could give me a lesson? Like, I don't know anything. Like, I have no fighting skills at all. And he was like, yeah, I mean, probably just the fact that you've played sports all your life is really going to help you a lot. Like, you can tell, like, some people he's worked with, like, they've never touched a golf club, picked up a basketball. They've never done anything athletic in their entire life. So he's like, I don't know if you could pick it up, like, super quickly, but you'll probably pick it up quicker than someone who, I guess, has no background of athleticism at all.
Yeah, and I think that's the most important thing, like, just staying active and doing things that you're interested in. I mean, I think that's kind of like why I picked up investing too, because like if you have a natural interest towards the thing, like you're gonna like want to learn as much as you can about it. If you're forcing yourself to do something and it's like not really for you, then like over time like your performance is gonna suffer. Whether it's like like powerlifting or golfing or even that. Like if it's like something, if you have to force yourself to do it, it's just not gonna always work out. I don't know.
Right. Yeah, and like I don't know. I feel like just with like working out, I think now, especially for us, it's a really good time for us to like build that habit and get into it. Because I was talking about this with one of my friends recently, and it's very easy for us right now to, I guess, go to the gym every now and then whenever we feel like it, maybe put it off here, put it off there. But the thing is, we're younger and we don't have a ton of responsibilities. Like we don't have a wife, we don't have kids. But the thing is, it's going to be harder to build that habit once we get into like our mid 30s and maybe we have kids, and we're going to get a lot of those days where it's like, I don't want to do this, forget it. And before we know it, we're not going to build that, I guess, level of fitness that we can easily build right now, because it's going to be much harder to build that habit as we get older. So I think it's very important for, I guess, our generation to right now to really kind of crack down and really move forward, building those healthy, good habits. So when we get into our mid 30s, we're used to pushing through, I don't want to say the pain, but pushing through, I guess, that mindset that we don't want to do this. Like we're too tired, because we're going to be way more tired as we get older when we pick up way more responsibilities as opposed to we are now.
No, exactly. I think that's important for sure.
Yeah, but let's kind of get into, I guess, the more investing portion of it now that we've kind of gone through that intro. We've talked for about, I don't know, 5 or 10 minutes here. But how do you really invest in stocks? Kind of what stocks do you own? How many do you own? Do you have any favorite stocks you want to talk about? Like, go ahead. Why don't you touch on that a little bit?
Yeah, so in terms of investing, I guess I'll start on how I got started. When I was in college, I was between kind of accounting and finance. I wasn't really sure, like, what is for me.
And you majored in finance?
So I started off in accounting the first 2 years I was in college. I ended up working at accounting firms. I worked at one of the big fours. It was Deloitte, so it's kind of like a PwC. When I was at Deloitte, I learned about audit. So, I would look at companies' balance sheets, income statements. I would, I would kind of gain an understanding for like how like inventories are measured, how different like how different ratios are. And a lot of that kind of helped me in like my fundamental understanding of stocks. But actually doing the work, like, like auditing a company's statements, going through going through their inventories and all that stuff was, for lack of a better word, incredibly boring to me.
See, I think everyone should take one of those classes, though. Like, everyone should be required to take some sort of class pertaining to taxes and accounting before they graduate high school, never mind college. Like, all this calculus stuff that people got to take this pre-cal to graduate. It really is. I'm going to have to bleep that out. But it really is, like, I don't know what the percentage is, but we'll say over 50% of people are not going to use calculus in the real world. I think that's a pretty conservative number on the low end. But everyone's going to have to learn about taxes. Everyone's going to have to learn like what they're going to have to do at the end of the year. No, like, why is this not being taught more? I don't understand. But anyway, go back to what you're saying. Sorry, I just had to put that in there.
No, it's all good. I think there definitely is a crisis in this country in terms of like financial literacy. And I think like accounting does take a big place. Like, accounting's kind of like the backwards piece of finance. It's like the historical aspect, whereas like finance is kind of projecting that out into the future. So, that's why like I took those accounting classes and I took those internships. And while it wasn't ultimately what I wanted to do, it did really give me a fundamental understanding of like how like, an income statement is valued and how to, project valuations for, a cash flow of a company. So from there I came back to college. In my school, we had this fund. It was called the RAM Fund because I was at URI RAM. It was basically like our endowment fund. So like like a college like Yale or Harvard, they'll have one of those. And they take 15 of the finance students who have, relatively strong grades, and they'll put you in a room, and basically we just execute trades for the endowment fund. So, we have certain parameters we set. So
is that paper trading? I'm assuming
No,
it's real money.
It's real money.
Really?
So
While you're in college?
It was a roughly $500,000 account. It was a piece of the endowment fund.
That's interesting. And now that's a $500,000 between all of you guys or just you?
No, between all of us.
All right.
So it was split up amongst the 15 of us, and we were broken out into sector groups. So, like, we would do, like, 3 analysts per team, and then we would cover sectors. So, like, for me, I was financials and real estate. I had buddies who were technology. Some team was, like, medicine, like, healthcare. So, like, we have to master those sectors. We have to perform analysis on the stocks that we want to pick for the group. And then we have to pitch them to the class, and then we decide ultimately on what we want to populate the portfolio with. And then we had certain rules. So, like, we were like a small cap, mid cap fund. So, like, we didn't buy stocks over 10 billion in market cap. We didn't ever allocate more than 5% to one stock because we didn't want to ever be, like, too undiversified. And then I'm trying to think. There was, like, I think, like, if it ever went, like, above 10 billion or above 5%, we would, like, trim it. But, like, we weren't day traders. Like, we had, like, a long holding horizon.
Right. Now, how much of that, just to interrupt you really quickly, and then we can get right back to it, because this is actually really interesting. How much of that you were doing was fundamental based, like kind of reading 10Ks and 10Qs, and how much was technical analysis, like looking at RSI, looking at all those different things, all those indicators?
I would say it was a good mix.
Like 50-50 or like 60-40, one way or the other?
I would say like 70-30 fundamental. So, because technicals, I think this is how I think about my process too, and I'll get into that at some point. But this is a lot of what I learned in this class really kind of shaped my viewpoint on stocks and where I buy. I would say when I look into a company, I do 70% of the legwork up front. I'm looking at the 10K, the 10Q,
right,
looking at statements by analysts, looking at their balance sheet, their income statement, how much debt do they have, what's their capital structure, where are those earnings going to grow. And that's a big piece of it, because if a chart can look technically strong, but that doesn't really have predictive capability. I mean, that's like, it could be like an AMC that looks strong right that week, but
exactly,
you know what I mean? So I think putting in 70 to 80% of the legwork up front and understanding the company, what they do, and where their growth projections are going to be, then once I have an understanding of that, if the stock's at all-time highs, it's tough to justify that valuation. Like, I think it's important to look at where it is, like, on a price basis, even after you've done the legwork. And then just to look, like, after that, kind of use some technical analysis to see, all right, is this overbought? Is this oversold? Are we in an uptrend or downtrend? Where's the volume at? If it's constantly at all-time highs, but the volume is really low, that's kind of a warning signal. Like, maybe it might be time for a technical break. So it's like, I would say, like, it's important to know what the stock's value is, but, like, once you have a sense of that value, kind of look for times to add, and not day trade it, because we're, like, looking to hold long, but we're also not trying to buy it and then see a 10% correction.
Right. Now, what you said something about all-time highs, and I got the vibe that was not a very good time to buy. But what if it's something like Amazon, where it's a company that's constantly hitting all-time highs, where all the metrics, I guess, you have to throw out the window for Amazon because they all say they're overvalued. But at the end of the day, when you look at the growth Amazon has going for it, the fact that in a couple of years, it really wouldn't surprise me if we saw, like, shipping within, like, same day shipping, maybe a couple of hours shipping, like 5 to 10 years from now. Like, think about it. If you go back a few years, we weren't having, like, 2-day shipping. Now he's down to 1-day shipping in a lot of cases. Like, if you order it today, it can be at your doorstep tomorrow. How do you justify a valuation like that when it's hitting all-time highs, but at the same time you see that growth? Do you just kind of go with your gut and just go with those fundamentals and just make a decision based off of that? Or
I think it's important too. Amazon's a special case.
It is a very special case. You're right.
Most stocks aren't like Amazon.
Right.
I think you can't look at things in isolation, though. You do have to benchmark. I mean, Amazon's a tough one because like I said, there's not a whole lot of stocks like Amazon. But let's say I'm looking at Amazon, and then I'm looking at, like a Exxon, or like another, like, large cap stock that's in a different sector. I'm not going to compare the PEs of those two companies, their cash flows, because it's a different sector. It's a different industry.
It doesn't make sense.
Yeah.
And there might not be as much growth in that sector.
Exactly. So you can't just say, like, this stock is overvalued because it has a 70 PE. Okay, well, what's the PE of the industry? Like, they have, like, consumer discretionary or technology ETFs that have the PE of the weighted basket of, like, what they hold. So I think like gaining a sense of like, all right, like a stock I really love is Nvidia. Nvidia right now has a PE of like 80, which is like, pretty high by historical standards. Then you look at their forward PE, it's like around 40. So they're expected to grow their earnings basically 100% to cut that PE in half. That's pretty strong growth. And then if you look at the semiconductor industry, if you look at like ETFs or similar stocks like at AMD or Taiwan Semi, they all have like 40, 50 PEs too. So it's like that could just be the industry. Like that could be like the type of nature. Like you kind of have to not look at things in isolation and realize like relative to where other stocks in that industry are and relative to Amazon, like being an industry leader, like that that valuation might be justified.
Right. Now, you mentioned a lot about the PE. Why don't you talk about some of your favorite metrics that you look at when you're looking into a stock? And for anyone that's new or listening, why don't you just kind of give like a really brief overview or breakdown of what they are? So like kind of like what the PE is, maybe if you look at price to sales ratio, what that is, just kind of basic things like that.
Yeah, no, I'd say that's a good thing to do. I look at, I think I don't use trailing metrics. I mean,
I think those are, I don't want to say they're useless, but I think if those were completely deleted from the planet, would make a huge difference in my investing process.
I mean, it's important to know where a company's been and like its historical, realize like have they met like targets in the past. But in terms of historical numbers, like I'm not gonna like put all my eggs on that. I'm not gonna put everything on that. I like forward PE because that gives me a projection of like where the earnings are growing to and like where people, like where analysts have a like target for the price. I think PEG is an important one. So PEG is they take forward PE and they normalize it, like they divide it by like the growth rate of earnings. So it's like the lower the PEG, the better. So like, all right, so like let's say we have two stocks with a 20 PE, but one of them has a PEG of like 1.2 and one of them has a PEG of like 0.8. Then like that means like they think that the stock underneath is like growing like 0.8 for like 20 PE, whereas the other one is growing 1.2 for a 20 PE. Like that's like more overvalued than the one that has like a lower growth rate, but like is more in line with their PE.
And what's a PE ratio, just for everyone listening?
Like around like a 20. Oh, a PE.
Like what is the definition of it? Yeah.
Yeah, it's price to earnings. So the numerator is pretty easy. That's just the price of the stock. Like that's pretty published data. The earnings per share is a little bit more tough to come by. I mean, that's also public data, so it's the price divided by the earnings. The reason, so I actually don't love PE. I'm realizing it right now. Like I'm saying PE a lot because that's like a very common metric for people.
Very standard.
Use.
I agree.
Yeah, like that's one of the most commonly looked at things. Not a huge fan of PE. Just coming from an accounting background, I know earnings per share. Like if you look quarter to quarter at a PE, it could be very volatile because some companies skew their earnings per share. Like they won't realize like if like they have like depreciation one quarter, like they might put it off to another quarter to like make their earnings look better, or like if they're buying back stock, or like if they're doing like a stock split, like sometimes like it throws off their earnings a little bit. So I think one of my favorite metrics that I like to look at is price to free cash flow. You can't really mess up free cash flow. Like that's like that's you can't really manipulate that through accounting.
And what are those two? What's price to free cash flow and what is free cash flow?
Free cash flow is just like the changes in net cash to the company. So, if their free cash flow is growing, that's like their cash position, but it's also like normalized by their like income and like, so like that, like it shows like where their income would be plus cash and like minus depreciation and other stuff. So it takes out like the effects of like taxes and depreciation, and gives you like a better view of the business. So I think price to free cash flow is a good one because you can't really like skew like the accounting metrics. Price to sales is good because, if a company has a really high price to sales, like, I don't know, like one of the stocks I was looking at was Snowflake. That's a very interesting company. They're basically like, they're really innovative in the data networks. But, they have a price to sales of like 200. Like even Tesla has a price to sales of like 20.
Tesla's also a interesting example for a lot of reasons.
But, so I think price to sales gives a good fundamental view.
And what's price to sales?
So that's just the price divided by the overall revenue of the company. So it's like a little bit more like it would probably be a little bit lower than PE because sales is going to be a much higher much higher number than earnings. And then lastly, I like to look at price to book. Book value. So that's price divided by the book value of the company. Book value of the company is just you take assets, or it's the assets minus liabilities. So it's just like the equity piece of the company. And if you look at like price to book value, like that's what book value is, like what the company's fundamentally earned at, like fundamentally like equity capitalization's at. So like if we have a price to book that's like 4, that means like analysts view this company like 4 times greater than like what the actual like equity on their balance sheet is. Whereas like if you have one under 1, that might be like the company's like kind of undervalued relative to like what their balance sheet is, and like that might be that honestly might be a little alarming too, because you're like, all right, why are analysts like you think they would be at least as valuable as the assets and the equity on their balance sheet? Like why are analysts kind of like not seeing that? So it could be it could be a value play, or it could be something where it's just like unfavorable stock. So you kind of have to look in. I think it's good to just compare it. Like they have sector ETFs, you can compare to the sector ETF and see where it is relative to the sector. You can compare it to like SPY or VU, compare it like see like how like the overall market is like valued, and then kind of just go from there.
That's very interesting. There was definitely some good value in that for everyone listening, for everyone watching this. Like I feel like that might have been a lot for people to take in, and I think I might take that clip and put it right at the front, or a certain portion of it. And if you're first getting into stocks, I would really recommend going back and maybe listening to that 1 or 2 times, because there was some good value in there, the way he breaks down those metrics and the way he explains those metrics. And then obviously you can go ahead and do some more research on your own if you want to do. But kind of to build off of that a little bit, why don't you go ahead and talk about kind of your process from the point where you first find a stock, you say, all right, I'm going to look into stock XYZ, the point from where you start to the point where you're like, all right, I'm going to buy it. What's in the middle there?
Yeah, no, of course. I think I'll kind of speak to my strategy. I have, I have my 401k, which is through work. That's like that's just funds, mutual funds. I don't have a whole lot of discretion in that. Then I have an IRA through Fidelity and a brokerage account through TD. You have to have a strategy. Like you have to go in and know like this is what I want to do with this account, and this is what I want to do. So like my IRA, for like the way an IRA works, and I'll break that down quickly. Like it's after tax money, so you're not going to be taxed on your short-term capital gains. Like so, like if not that I do day trade, but if I was to buy and sell a stock in my IRA, there would be no tax. Like there would be no tax to me. Whereas in a brokerage account, if you sell a stock and realize a gain within the year period, that's a much higher tax rate than like long-term capital gains taxes. So like in my brokerage account, I'm much more conservative than my IRA because of the tax implications of that. Like in my IRA, I can buy and sell if I want and not realize those taxes, whereas in the brokerage account, it's going to be much more of a cost to me.
Sorry, there's a fly.
No worries. So the brokerage account, really what I do is I focus more on like large cap stocks. I focus on, I don't think like in the large cap space, there are so many analysts and so many supercomputers analyzing these stocks that I don't think there's a whole lot of alpha that I can really add in that space. So really the only way of outperformance, but for me, is to tactically underweight and overweight different sectors. So what I'll do in that portfolio specifically is it's more ETF driven. So I really own like maybe like 5 to 10 stocks in there and like 10, maybe like 10, 15 ETFs. And I'll underweight and overweight based on where we are in the economic cycle. So in that specific portfolio, I look at it as a large cap sector, like, deviate the sector from like where it is in the S&P. So if the S&P has 5% weight towards energy, but I view, I think inflation's going to pick up. I think oil prices are going to go up. Maybe I'll put 10% of my weight towards the energy ETF and kind of deviate in those ways. And I've tend to found in that specific account, my performance is kind of like distributed kind of between the NASDAQ and the S&P. Like for example, if the NASDAQ is up like 1% in the given day and the S&P is up like 80 basis points, I'll be around like 0.9% performance or 90 basis points. Whereas like on a down day, like let's say the NASDAQ's down more than the S&P, I might be down more than the S&P, but I'll also be like kind of like less down than like the NASDAQ is. So I try not to look day to day. I kind of try to compare my performance week to week. I think like week to week or month to month is a much more comparable performance because like, there's so much noise in a given day. But, I think it's important to realize like, okay, my brokerage account is taxed. I'm not going to be as like, I'm not as risky there. I'm going to stick with large caps. I'm going to stick with ETFs that kind of convey the sectors of the S&P 500. And where I'm going to add value is I'm going to overweight specific sectors based on where I find we are in the economic cycle and kind of take more of a macro viewpoint and start like from the top rather than like the bottom. So that's that account. Then my other account is the IRA. That one, I just do stocks. So it's a completely different strategy. That one, I just do like kind of like RAM fund. I stick to small and medium caps. I think the largest cap stock I have in there is maybe like 20 billion, which I guess is technically larger, but I really try and stay under that 20 billion.
What's the second largest one? Do you know off the top of your head?
I would probably say like 14 or like I would say more often than not, like most of my stocks in that portfolio are like under like 5 billion.
So that must be more of a volatile portfolio because obviously small caps are going to be more volatile.
Yeah, and I think that's like, for me, I think that there is a lot less analyst coverage. Like for like a stock like Apple, you got hundreds to even thousands of analysts covering that stock. They know all the news before I even get my alert on my phone.
Right.
Whereas, there's more inefficiencies in the pricing of like small caps because like,
yeah, so those like small cap companies, you're going to see some of them where like only like 2 to 3 analysts cover like that company. So if you can get into those and you find those companies and they're very undervalued, once Wall Street money really starts to come into them, that's when you can really start to see those big moves in the stock. Like you can see like 25, 30, 35% in a day because Wall Street money is coming in. And then once they see that, and once they see the opportunity and growth behind it, then you're really in the clear and you're really looking good.
Yeah, no, I think that's definitely a key thing. Like, you have to also realize too, like a lot of these companies that are 5 billion in market cap, like, yeah, there's a lot of zombie companies out there. There's a lot of companies that are just like the Wall Street bets, like don't really have any fundamental value. But there are some strong balance sheet companies. There are some companies that have great earnings growth. They're just in a smaller industry, and like if you can find a strong balance sheet and it's something that is 5 billion in market cap, who's to say it can't go to 100 billion in market cap? And that's what 20x growth versus if Apple was to 20x and it would be like bigger than the world. Like, you know what I mean?
Right.
Like,
and like some of these companies, you see people talk about things like, oh, it's all at all-time highs, I'm going to sell it. But the thing is, like, if the company's executing on all cylinders and everything's going according to plan and they're still being innovative, what's the point in really selling it? Unless, of course, you have a better place to put the money, you see a better deal, or maybe you feel like that company has gotten a little bit overvalued, a little bit ahead of itself. Obviously, those are all things to take in consideration. But a company like Amazon, is a great example, and it's also kind of like a diamond in the rough here, where it continually executes, continually innovates, like continually does great thing after great thing and puts up great numbers. What's the point in selling it?
I mean, there really isn't any. I mean, as far like, I really cannot see there being like, this is not financial advice at all, but I cannot see another company doing what Amazon does. I can't really like sure, they have competitors, like they have like there's Etsy, there's Shopify, there's other people that sell online and have a marketplace for people. But in terms of their full suite of products, like the web services, even they just sent Jeff Bezos. They're sending Jeff Bezos to the moon next week. I mean, like it's kind of crazy. Like I can't really see it's a safe place. Like it's not gonna get you like 5x, 10x returns. But if you're someone like who has like spending obligations or liquidity needs, and you want that solid like 5 to 10% growth per year, like that's a great stock for your money.
Amazon's just one of those stocks like where I look at and I'm just like, it's literally impossible for me to imagine 5 years from now this stock's not worth over like $5 or $6 grand like a share. Like it's almost like I put like a 1% chance on it. Like you know what I mean?
Yeah, no, I could easily see that stock going. Like, I mean, what is it? Is that at 2 trillion now? I think it's at 2 trillion now.
I think it's just under. I think it's like 1.7 or something like that. It's definitely not at 2 trillion yet. I don't think. I'm not sure. Is it? I'm actually not sure.
It's probably right on the cusp, if not at 2 trillion.
I think it's close because Facebook just hit $1 trillion. Now, I think that's the most undervalued company in the stock market. I think Facebook's one where I'm like, Facebook, it's almost impossible for me to imagine Facebook not being a $700 stock in 5 years.
Yeah, no, they have a lot of room to grow. They have a lot of runway.
How did you first get into like stocks investing? I know you kind of talked about that a little bit early on, but how did you really get your interest peaked at first?
Well, I think too. So I was telling you guys about that course I took, and like kind of like my internships where I would learn about like like balance sheets and like different accounting ratios. Another big piece of that really piqued my interest. So my school, University of Rhode Island, we were CFA accredited, or we had a CFA like standing. So like, I don't know if the CFA basically it's the Chartered Financial Analyst. It's kind of like a CPA, like a certified public accountant. It's basically it's a 4-year designation that basically is supposed to certify you as an analyst. When I was in Ram Fund, there was a scholarship for that. And I was already so enamored by what I was doing in Ram Fund. I was loving, selecting stocks, trying to find inefficiency in the small and medium cap space. I was like, how can I learn more? Like what would kind of bring me to that next level? So they had that scholarship offered to me, and I was able to get it. So the way the CFA works is there are 3 levels. Each level is only offered once a year. So, that's the old format. I think now that after COVID, they kind of changed it up a little bit with everything. So I think it's like 2 times a year now, but it's still like very like because you need 4 years of work experience too, in addition to the 3 years of testing.
Right.
So you can't get it within even if you take like 2 tests a year, like and get it in like a year and a half or so, you still would have to have the 4 years of work experience. But anyways, I took the CFA level 1 this past December. I'm taking level 2 in February of next year. And it's basically, and it's on everything investing. So it's 10 subjects broken up into about 60 chapters or so of information.
What subjects? Do you remember off the top of your head?
Yeah.
What are they?
Well, I guess I'll try and name all 10 if I can. It's
as many as you can.
It's economics, accounting, equities, derivatives, fixed income, quantitative methods, so like statistics and like kind of like probabilities, alternative investments like hedge funds and private equity and real estate. I'm trying to think if I'm missing any. Like ethics, and I think that's really all, like portfolio management. But so I took that exam, and that exam was the hardest thing I've ever done.
Really?
It was by far the hardest thing I've ever done. I was a pretty good student at URI. I graduated summa cum laude. I was on the Ram Fund, and I think in those 4 years, like I studied for this exam for like 4 or 5 months. I think, and I hit it 2 hours a day. I think those 4 or 5 months, I learned more. Not to discredit URI, but I learned more and had more under my belt in those 4 or 5 months than all 4 years of college combined. And it was such a like talk about like going to the, like we were talking about going to the gym earlier, like it's really about showing up and being persistent or consistent. That really helped. Like it was like there were days where I woke up, I might have been maybe I was out with some buddies last night and I was maybe a little tired, or I just wanted to go over to the beach. I wasn't feeling it. It didn't matter. I had to do 2 hours a day, sometimes 3 on the weekends. And then even like the last week before the exam, I was probably doing like 5-6 hours a day. Like I was nonstop. Like it's on 60 chapter. I think it's like 57, but I'll just say 60. Each chapter was probably like 30 pages. It was 5 textbooks of information. So wow. I wouldn't say I'm the smartest person, but I'm definitely a really hard worker. So to have a footing and really understand all those like chapters and like understand like the equations and like what was asked of you, I just had to grind at it every day. And that gave me such an appreciation for investing because I was able to see it from every side of it. Like I was able to see, okay, economics, where are we in the economic cycle? What is the Federal Reserve doing? What are interest rates and currencies, and what are, how does that interact with things? I was able to see derivatives, not that I trade like options or futures, but I was able to say like how do those impact the markets? What is an option? How do dealers work? I was able to see like the accounting piece of it. I was able to see, the bond side of things. Even though interest rates are really low and bonds aren't something I would invest in, interest rates and bonds do have a large impact on the market that most people aren't really as aware of. So I think just having that whole holistic approach to things and kind of really putting in the work and realizing like this is how much effort it takes to be successful in this industry, really just like honed my skill set. And I still have so much to learn. Like I hope that I can convey myself as someone who knows a decent amount, but like I still have endless. Like I think that's the best thing about it too. I think that even if you feel like you're in a good spot one day, you can always learn 1,000 times more.
Always, 110%. You can always learn more.
Yeah.
And I think what you said about you really putting in the work when on days you really didn't want to, if you're tired, is really so important. And I was listening to the Joe Rogan podcast the other day. I was listening to one of them, a section of it or something. And he talked about something where he was just saying, anyone can be me. Anyone can be me. And at first I was like, what's he referring to? And he made a point. He's like, I just stuck with everything I've ever done. He's like, I failed like tons of times. And I always thought he was an idiot. Like always. I thought he was just some guy who wanted to just, be on TV, make a lot of money, and then go get drunk at UFC fights. I really thought that's who he was. And you listen to these podcasts and you listen to the way he talks, and I understand why people don't like him. I understand the way he portrays himself might seem a little arrogant, maybe so cocky. I can see why people don't like him. But he's actually really smart, and he makes a great point. He's like, I just stuck with it. He's like, it's not about the days you work when you're motivated, because everyone's going to have days when they're super motivated. Everyone's going to have a day where they get all the chores done way faster than they expect. Everyone's going to have a day where they accomplish their goals way faster than they expect. But it's about those days where you wake up and you're like, I don't want to do this. I don't even want to look at this. I don't want to open the computer. I don't want to go for a run. I don't want to go to the gym. I don't want to do these things. Those are the days where you can really force yourself to do it more times than not and really get a lot of work done and push through that. Those are the times, and that's really what's going to separate the successful from the average, I truly believe.
Yeah, no, I think that's like, I know we're gonna get like Mike Pence flied, like it's gonna be like,
I know, like, oh my God.
No, it's funny. No, I think like that is why I love investing, and I just think like I just think it's one of those things where even if you are outperforming one year, like perfect example, look at ARC. Like last year, they were crushing it. This year they're getting murdered. Like it's like you can't like. You have to always be willing to adapt and shift your strategy and learn more because, even if in those years of extreme outperformance, you might have insane drawdowns in the next year, and you kind of have to reevaluate, okay, what was I doing that was working? What was I doing that wasn't working? Should I change it? Has the business fundamentally changed? Is it just sentiment? Is it, are we experiencing a more prolonged drawdown? Like, is it, are we going into a new economic regime? I think just being able to evaluate, like take stock of where you are and like what you need to do and just be constantly adjusting your view and like in lieu of that is like so key to investing. And I just think that's, key to life. Like you have to just like take in the scenarios around you and put in the work and realize like, okay, this is where I was, this is where I am now. What do I need to do now to get even better?
How many stocks do you own right now?
So I was saying, in that brokerage account where I'm more conservative, that one I only own like 5 to 10 like large and mega cap, and then mostly ETFs, kind of like underweight and overweight the sectors. In my IRA, this number might sound like a lot, and it could be. I own roughly 25. The reason I do that, you could technically accomplish something similar to that with an index. Not. Some ETFs hold 30 stocks. Most index hold at least 100 to 500. So it's like you can't really replicate that through just a single account. But I want to have coverage of every sector, even if it's like, I'm not like crazy bullish on commodities right now. Like I think like I do kind of lean towards the inflation is transitory camp. So like I'm not gonna have like 10% of my weight in like copper miners or oil stocks. So like I'm not going to have a significant portion of my portfolio allocated to like an energy stock, but like I still want to have coverage of that sector because I still think it's important. Like, let's say I'm wrong and inflation is, here to stay and energy price and gas prices are through the roof. If I still have like a 2% allocation to some energy stocks, that could save me from drawdowns in my other, sections of my portfolio. So I think it's, even if it's just 1 to 2 stocks, I think it's good to have a stock in each sector and kind of get the full investing view. So that's why I have so many. I think one of the reasons I underperformed last year and I've outperformed this year versus like the benchmark, is just because of the sheer amount of work it took to get each stock in that portfolio. Like I was saying before, you have to, I was reading the 10Ks. I was on I was on earnings calls. I have alerts set for everything on my phone. So like, you can go into your brokerage app and set an alert for price. You can set an alert for news. You can set an alert for like an analyst upgrade or downgrade. So I was doing that with 25 stocks. So
what app do you use for that?
I use TD Ameritrade for a lot of it. I mean, I also have, I think investing.com has an app. I like Finviz a lot. If you go on finviz.com, it has like it shows you the chart. It shows you like the earnings per share growth and sales growth quarter over quarter. It shows like other like value metrics. So like I'll do that, but just to get into a stock, it might take me like at least a week to 2 weeks. And then if you have 25 of them, that could take like a year. So like just last year, like I got lucky. Like it's funny. I didn't mention it. I should have mentioned this at the beginning. So when the first time I started, so I have all this theory behind me. I took the CFA. I did these investing classes. I was like, all right, I should be good. I'm gonna, I'll be smarter than the average Joe. I started my investing journey the end of February of 2020.
Really? That's when you first started getting into the market.
That's when I first put my first $1,000 in.
And then it went right down.
Yeah, I lost
it all.
I lost probably like half of that money. I was like, wow, this is awful.
That's funny.
What happened to me is I was looking at it and I was like, I had all these stocks on my watch list and I was like, some of them were down like 60-70% from their highs. I was like, that is ridiculous.
Yeah,
like,
those valuations definitely got really stupid at that point.
There were funds. I'm not trying to get like I said, I'm not trying to get too accounting heavy. There were ETFs. The way like an ETF trades at NAV, like it's like I won't get too accounting heavy, but there were ETFs trading below NAV. Like there were which is like they were trading below the assets that they hold in their ETF. Like there were stocks that were. You take a company like Apple. Even Apple was off like 50% from the high. Like, I just was like, this is ridiculous. So I actually went in really heavy, like around like end of March, April. I did not call the bottom. It was pretty much pure luck. But I went in really heavy around April. I was like, all right, like I've already lost half this money. If I lose another half, I might have to stay at home for longer. But
that's funny.
I just kind of went all in. I got lucky, but I also did a lot of work. And I think some of the reasons I really outperformed in that large caps account because I just went all in, and some of those large caps bounced back like
a lot of large caps did.
Yeah,
large caps I think are the most overvalued, I guess, equities in the stock market right now. Like I do not think that is where the deals are right now by any means. They're starting to even out. They're starting to come a little bit back down to earth, but I still think there's much better deals in the mid caps, and like I said earlier, in the small caps. That's where the deals really are, I feel like.
So I would say that's why like last year I tended to outperform in the large cap space, and this year I've been kind of more stagnant, kind of just like performing in line with the market, which I'm cool with. I mean, I'm fine being 12-13% in a year. Like that's perfect for me.
Great.
Yeah,
that's fantastic.
I'll take that. Like, and then this year I've been kind of more focused on the IRA account, kind of trying to grow my small and medium cap portfolio. I think some of the reasons I've underperformed is just because of the sheer amount of time it takes me to look at these companies. I mean, if I had a team of analysts or like a algorithmic computer that could just kind of read through the 10Ks for me and kind of do all that legwork for me, maybe I'd be able to allocate more quickly.
And that's the thing, when you own, say, 25, 30 stocks, right? It can take a while to find a new one that you really want to even look into, because on top of looking into new companies, looking for new opportunities, you also have to stay up to date with the 25 to 30 equities you already own to make sure, everything's in place, the management team's executing, the fundamentals are still there. It's a lot more work than people think.
No, exactly. I think, a great place to start, like I said, is just to, go on. Every public company has an investor relations site, so just hammer that. Go through everything you can on that site. Even if it's like a press release, which is written by the company, it might be a little bit biased, but look for as much unbiased information as you can. And then a big one that I actually have been doing a lot recently, which is kind of more uncommon, I think, is sentiment gauge. I think I don't base my whole like process on this. Like this is probably the last step in the process. Like after I've already looked at it fundamentally, after I've already kind of looked at the price and the trends, like some of the TA work. The last if I do like 70% fundamental, 20% technical, I'd say the last like 10% of the piece of it is a sentiment check. So if you have a Twitter or like even like a Reddit, you can take any ticker just put a money sign in front of it and type in the ticker, and you could see all the top tweets about that stock. You could see what everyone's saying. You could see, what the news is recently on it. You can see like some popular like analyst accounts on Twitter. Like you can see like what the heat check is of this particular stock, and like that doesn't, while that might not have predictive value, it's hard to like really gauge just off the sentiment of others. I tend to be in the camp that like behavioral finance is a big piece of things. Like, when market sentiment is positive and there are stocks that people are constantly buzzing about, that tends to be a good sign. I mean, if it's
even AMC or GameStop.
I mean, it's tough. I mean, a lot of those guys are smart. Like the people, like you would be surprised. I read through a lot of those Reddit forums. Like the guy who actually started the GameStop like thing, like the Kenneth Gill, like Roaring Kitty guy. He's a genius. Like,
well, that's the thing. Some of these guys that get into it early, I could have seen a legit argument like months and months and months ago that both GameStop and AMC were very good turnaround plays. Like they were undervalued for a lot of reasons, and they were just beaten down because they were, very, very shorted and all these different things. I could see a legit argument behind that, and I could justify that current valuation or the valuation at that time. But now it's like, if you're getting into it, it's just like there's way too much positivity around these stocks that there shouldn't be.
I mean, yeah. I mean, if you take a look at like GameStop, like it was trading at like $4 a share. It had like 130% short interest. Like it was so insane that like some guy realized, like, listen, like this thing has so much short interest against it. Like if I can get enough people on my side, this thing can make a difference. Like we can squeeze this, and like that wasn't even the guy's original intention. He actually did like Kenneth Gill, the guy I'm talking about, the Roaring Kitty guy who started the GameStop. He actually is a CFA. Like
I know.
Yeah, he's a CFA, and he works at an investment firm. Like he's like he's established in the industry. So like he actually had a good understanding of what he was doing. The people that followed, not so much. I mean, like the apes together thing. Like I don't really go with that. And now, oh my god, now it's like. I would believe at first that it was retail investment, but now at this point, there's no way. There are so many algorithmic funds out there that just look for anomalies like that, and when there's a volatility spike like that, they have these quantum computing and supercomputers. They'll pick you off in a second. It's like if I were to try and buy AMC right now, it'd be like me going on like trying to like try out for running back for the Patriots. Like it's like they're so quick at picking off retail investors at this point. Like they already, the initial spike might have been retail, but at this point the hedge funds and like some of these bigger like quantitative firms, they know what to look for. They if you're riding the surface now, you're probably gonna get blown out.
Right. It's interesting, kind of, I know we're really backtracking here, but going back to what you were saying about holding 25 or 30 stocks, it's interesting how we differ on that, because me, and I know I've said this to you before, but I just said to you, I'm like, I would just go buy an index fund. I'm more in the camp of, I like the Mark Cuban method where I say diversification's for idiots. I'd rather put, the majority of my capital of the equities that I really understand and really believe in and diversify less and see greater returns, because I've done my full research and I've done all these things that I should be doing before I invest in something, before I invest not only in a certain asset class, but in a certain asset. It's going to work out for me in the long run. As opposed to you just try to be as diversified as possible, which brings me to my next question that I want to ask you. Do you plan on eventually, or even within maybe the near future, diversifying into different asset classes, or do you just plan on sticking to the stock market?
Yeah, no, that's a great question. I definitely right now I'm, allocated to stocks. I want to eventually, have more real assets, like more real estate, maybe like rent out like a single family or like a duplex type of home. I would like to have more capital first and kind of have a deeper understanding of that piece of investing before I got into that. In terms of like commodities, like I'm not gonna go out there and buy gold or like copper. Like and even like to have exposure to like commodities like oil and stuff like that. Like if you're in the camp that like inflation is picking up, you have to trade through futures, which isn't like something I'm gonna do. I think it's important, like, for me, so at the beginning of the year, when Biden was announcing his like infrastructure plan, I had a feeling like, okay, this is very bullish for commodities. This is very bullish for materials because, how are they going to make these roads? How are they going to make these buildings, these bridges? So I was very bullish on like iron, on copper, but I'm not gonna go out there and buy iron futures, or like I'm not gonna like try and like allocate my money there. So I look for equity like exposures in other asset classes. So like I have a few copper miner stocks. I have a few like oil exploration. Like I have an oil exploration ETF that I find interesting. Like I wouldn't overweight those sectors because I don't think it's like necessarily like the long run like if we're gonna be like doing this infrastructure thing forever. But like for this year and like the coming years, I think that like that's an interesting approach. In terms of like having 25 to 30 stocks, I just think like the way I was taught to invest, like never to have like more than like 5 to 10% in a single position. I think that still is key to me, and it's been tough because there's been times where I've had winners like where that they have gone up like 100%, and now it's like 10% of my portfolio, and I'm like, all right, this has been killing it for me, but like, should I continue to hold? Like, how much of that growth is really baked in now? Like, could I put my money elsewhere? Like, do I really want the volatility of this one stock to dominate my portfolio? I think I can do better. So what I'll do is I just want exposures, and I think the rotation of this environment, like we're already at all-time highs. Like market breadth is pretty weak. So like market breadth is like this thing where like it's just a participating, like it's like while the indexes are going up, how many stocks are participating in that index move. So like if you look at the market right now, we're like even in the last week, every day or so like has been like kind of down in the index. But if you look at like tech stocks, they've all been up. So it's like, yeah, like technology might be holding up the market, but like does that mean like, you know, is that like a more foreboding sign than like other sectors? Like am I worried like, all right, yields are coming down, like that might be bad for financials? Like, oh, like, you know, energy prices are kind of high right now, can they really go much higher? Like am I worried about like the energy sector? So I think it's like good to have like it's good to be fluid and know like there are certain mechanics in the market that can move different sectors and have exposures there. So that's why I like to have exposures to every sector. But I also don't want to like overweight one thing and like be too exposed to the volatility or like individual company risk of like one firm, because it's just, I don't know, that's just I might be more risk averse, and that might just be my style of investing. But I just tend to find value in being allocated to each sector. Sorry, I got off topic.
No, you're
off
fine.
topic about the different asset classes. I think the last asset class that I've looked a lot into but still haven't allocated any personal money to is crypto. I find crypto very interesting. I think that, you know, in terms of the future of money, there's a lot of interesting, like, you know, they take out the financial intermediary. It's open 24/7. You don't have to go to the bank. I'm cautious because if you look at the arguments for Bitcoin, you got two, the main ones. It's, you know, it's either a unit of account, like it's the new currency, or it's a store of value like digital gold. Well, okay. I mean, if it's a unit of account, you know, Bitcoin, to send a Bitcoin through the network, it has to be approved by all these like nodes. That takes forever. They only send like 400,000 or 500,000 payments a day. If you look at Visa, they're sending 100 million payments a day.
Right.
It's just not an efficient system. Like, so like, all right, so I'm kind of out on it as a currency. Like, I'm not going to send my friend Bitcoin. So if I look at it as a store of value, kind of like a gold or like a bond or something, okay, it just drew down 50% from the peak in like 5 weeks. So it's like, how much of a store of value? Now I'm still bullish on it long term. Like, I think that there is interesting applications in that network, and I think even like in the Ethereum network, like with like these NFTs and these different like video game type things, like, or like the Top Shot NBA, like I think that's interesting space. But for me personally, I would just like to see the volatility settle a little bit before I got into like crypto investing. And I would like to see, you know, them pick up the payments a little bit, or kind of figure out what their niche is, because right now I don't think they're too great at either of the two things they say they're good at. But that's my personal opinion. I mean, if you have crypto and you love crypto, I'm sure you could convince me too. I want to know more about it. I just think that right now I wouldn't want to allocate money to something that highly volatile.
Yeah, I'm kind of in the same boat with crypto. I'm not really sure how I feel about it. I've been doing some work on more like Coinbase. I find that as a more attractive, even though it's like an indirect play to crypto. But I just don't know if crypto is the best place for my money, I think, at the end of the day. It's interesting. I'm not there yet. I'm really just not sold on it. I feel like there's just better places I can put the money. There's better deals. It's just one of those things. It just hasn't completely clicked for me yet where I feel completely confident. I do like Bitcoin. I do like Ethereum. I think crypto's here to stay. I don't see anything wrong with it. If you own crypto, if you don't own crypto, I can't say I disagree. I can't say I agree. I'm just kind of in no man's land with it at the end of the day. But I think I'm kind of really in agree with you on that asset class as a whole. But moving on to the next topic here, let's kind of talk about, we talked a little bit earlier about how investing should really be taught in schools, accounting, all these different things, because it's things that really, A, is going to better everyone's lives financially, and B, it's something everyone's going to really have to deal with at the end of the day. But why do you think, even though it's so important, so many people ignore it, they don't get involved in it, they get stressed out by it, and they really just end up relying on the 401k from their job, and that's their investment portfolio?
I mean, I would say a lot of it is, I would say there's two main things. I would say it's scary. I mean, like,
it's very scary.
It could be scary. I mean, for me, the timing I invested at in the end of February 2020.
Oh my God.
I was like, this sucks.
That must have been so bad to just see, like, you put all this money in, it probably went up like a little bit for like a couple weeks, and all of a sudden, right down.
If I had the money in now that I had then, I would be pretty upset. But I mean, you can't look at it like that. You have to have a long-term view, because like it can be scary. Like, it's volatile. Like, it's not as safe as just going out and buying a bank CD, or like, you know, buying bonds for like a 1% coupon. Like, it's just not. It's not as safe. Like, there is risks to the market. And then I would say the second thing is just time. Like, right now for me, especially during COVID, like, I was inside. Like, I had a lot of time, like, throughout. Like, I was hybrid working for my job, so like, you know, if I wanted to take like an hour to just like kind of like research some stock and then kind of come back to my work later in the day and log back on later, like, I could. And I had a lot of time to look into these companies with the lockdown and everything. You know, I don't have like kids of my own, or like I don't have like my job is demanding, but like I'm not working like 6 days a week. Like, I only have like the Monday through Friday schedule. So I have the time on my side. I can research before and after work. I can set alerts and kind of check throughout the day. A lot of people, you know, when they have families, when they have obligations, when they have like night jobs, or, you know, like if they work in like a restaurant or like the service industry, it's tough. It's, you know, it might just be more value add to just throw your money in an index fund or an ETF, not look at it, and, you know, add portions of your paycheck where you can, and just dollar cost average. Like, don't worry about like the volatility of the market. Like, just do what you can. And that, I might get to a point in my life where that's what I have to do, because of just the amount of hours I have to work. And there's nothing wrong with that strategy. You're still investing. You're still not sitting on the sidelines, and there's nothing wrong with that.
I said that on the podcast with Blake. I'm like, I know there's going to be a point in my life where I'm not going to want to, and I'm not going to be willing to put in the work to pick individual stocks. When that's going to be, I don't know when that time is, but I know it's going to come eventually. I know, you know, when I have a family and kids one day, if that's on the horizon, that's going to obviously take the first priority over what Apple did on their earnings report. It's just like, that's just who I am, and that's what I'm going to do. I'm okay with that, which is why I'm really putting everything into all this stuff now. So maybe down the line, I have enough capital where I can just put it in an index fund and just continue to see that, you know, 8 to 10% return on the year. But you talked about how a lot of the reason that people don't invest is because of the fear they have, right? How do you get by that fear? How do you get comfortable to the point where you're like, all right, I feel comfortable, I feel okay, I'm ready to take this leap to put some money into the market? Yeah,
that's a good question. I think that, you know, like I said, I'm not like in the huge like inflationary camp, but like there is inflation. Like, let's say it's even like on the lower end. Like, let's say it's between 2 to 4% a year. Okay, if your money is sitting in cash, being devalued. If your money is in a 1% bond, you're still not winning against the real rate of interest. I mean, if inflation is picking up and you're not getting a promotion every year, if you're not making more, if your salary is growing at the rate of inflation, you might kind of be in line with it, but like, it's just hard to grow your earnings in line with like how like the price of living grows. So for me, like if I can earn even 5 to 10% a year in the markets, like that 5% is 500 times what like a bank is gonna pay. Like, you know what I mean?
Right.
Like,
That's a good way to look at it.
like it's just, you have to really like I don't know, like a savings account. What is it, like 0.01% interest? Like even if you buy a 1% bond, like which is pretty much risk free, like that's still like 100 times, or like, you know, that's still a lot more money than you're gonna in the long run than just having it parked in savings. So like I think just being willing to take that step and realize that like most of America like has some intrinsic value linked to the stock market, even if it's like if you're a teacher, your pension plan is probably linked to the market in some way. Retail investing is growing from like, you know, it was like 10%, now it's like 25% of the market. Like I think just the moneyness of the market and how much people rely on their saving, like on like the market to fund their like retirement, like you kind of have to like be involved in some capacity, even if it's just like a few $100s like a month, or a few $100s a year. Like it's good to like be beating that rate of inflation. And I think too, like at this point, like I guess like with the Federal Reserve like cutting interest rates, the same, like you in the 90s, in the 80s, you can get a 30-year bond like 7% interest.
Right.
Like you could just buy that 7% coupon bond, collect 7% a year.
That's the thing. That's where the deals were at the time.
Exactly.
Like savings accounts, bonds. That's where it was.
Now with the regime we're in, where like rates are so low, and like there isn't a whole lot of growth otherwhere in other parts of the market, it's like, okay, I have to shift out the risk curve a little bit, but like it's still better to be beating that inflation rate, to be, you know, just not parked in cash. Like you want to have some growth in your income outside of just like your normal job. So it's, I just view it that way. I try not to look every day. Like I do have certain, like if I have a stock that I'm looking to add to, and I have like a price alert set and it's like below that price, and I'm like, all right, like let me add on this dip. Yeah, like I guess that's technically a day trade, but like those are long-term positions. Like I'm looking to add to those long-term positions, but I'm not checking every 10 times an hour like, oh my god, my account's down 1%. Oh my god. Like I think that's like something that new investors do. I mean, when I was in February, I was checking like every 3 seconds. I was like, oh my god.
Huh.
But I think it's important to just take a long-term view, realize that we're kind of in an uptrend. Even if you look at 2008, which is one of the biggest crashes in history, like even from there, we're still in an uptrend. So I think there's more reward in the market to come than downside. I also think short term, it's important to know where we are. I wouldn't, right now, I'm kind of comfortable being where I'm at. Like I'm not really looking to add a ton right now. I think if you throw all your money in at an all-time high, you might be a little disappointed. But I think it's good to like pick and choose, like to add a little bit where you can, add a little bit where you can, not throw all your eggs in at once, you know?
Yeah. And it's really interesting to me because when I tell people I'm really into the stock market, I tell people that the majority of my wealth is tied up in the stock market. They almost look at me like I'm insane, to put it mildly, I guess you could say. They think, because there's this big stereotypical, I guess, sentiment behind it that the stock market is gambling, which I was also under that impression for a very large portion of my life up until like maybe the last like half decade or so. And I really just want to look at people and I want to say, do you have a 401k? And obviously most of them are going to say yes. And I'll say, what fund is that money from that 401k in? I guarantee you 9 out of 10 people could not tell me what that is. That is gambling. And it's crazy because it doesn't even have to be like just your average Joe. It can be like the head of a company. I was working for a company for a while, and I went in and I asked my boss, I was like, hey, can I pick my own stocks? Can I pick my own funds for my 401k? She kind of laughed at me, and I'm like, no, I'm serious. Like, I want to do that. She's like, oh, hang on. And she like brought everything up to the person in finances. She went to the president, and it's like no one could get this answer for me. I'm like, can you people just get it together? I'm like, what is your issue? Like, how can you even run an operation when you can't get this stuff like lined up? Like, this should be common knowledge. The common knowledge. I literally did not understand it. Sorry. Had to go on that rant there.
No, I think that's important. That's funny because actually I just started a new job like 2 months ago, and they were setting up my 401k, and they were just ready like to throw me into one fund, and I was like, wait a minute. Like I was like, I need to look at these funds. I need to see like what their holdings are. Like obviously I'm not going to like if it's a S&P 500 fund, like all right, that's pretty, like I'm not going to look at like, you know, that's pretty self-explanatory, but like I don't think it's good to throw 100% of your money into the S&P 500 because that's like, that's pretty efficient. That's the 500 biggest companies in the U.S. Like those are pretty well covered, pretty all-time high. Like you kind of want to have some exposures to the medium and small cap, and you might even want to have some exposure to overseas, like or even maybe like different sectors of the economy. So I think me being able to be like, all right, maybe I want to have a position in this small cap fund. I want to have a position in a growth fund. Like I think it's good to like be able to have that decision and discretion over your account. It's definitely going to be a much more conservative in line with the benchmark account than like, an active like 25 stock account. But I think, if I was going to manage 3 accounts, I would probably have no hair. So it's like, it's not worth it for me. I'm cool with them managing that aspect of my 401k. But I think like, it's a time thing. It's a time and a fear thing. And I think if you can get over that initial fear of like, what if I lose my money? Like you have to be willing to put that money aside. And you have to also realize like, there's a very, very small chance you're going to lose 100% of that money. Like if you are throwing, even if you throw a lot of money into GameStop at the peak, you still haven't lost 100% of your money, hopefully. Right. Like for a company to go to zero, like it has to be like pretty much a fraud. Like it has to be yeah. Like it has to be like an Enron. Like you have to throw it into like a really terrible company, and if you're like if you've done your due diligence, if you put in the work, like the odds of you putting it into a company that goes to zero and you not realizing that through all the research you've done,
it's almost impossible.
Yeah, like
unless sometimes you're going to get unlucky, like a once in 100-year health event breaks out and the world shuts down, but that's just going to happen. Like, and that's almost you'll never see that. Like, we'll never see something like this. Probably. I mean, never say never, but I would say the odds are in our favor. We won't see something like this again, where the entire world just shuts down and money velocity just stops overnight. I find that very unrealistic personally.
Exactly. And I think like there are times like this has happened to me where I've absolutely loved the fundamentals of a company. I've absolutely been like their technicals are good, like they're in an uptrend, like they're not getting like too oversold. Like I'm like, this is a company I want to own. I'll put my money in. It drops like 5-10% in a week, and I'm like, all right, I'm an idiot. Like, what have I done? But like, but like, you have to get over those short-term feelings because I'll check the news. Like, I'll check Twitter. I'll check the company's website. I'll see what's up in the media. Nothing's changed. Like, it's not like the company's like laying off everybody. It's not like they've discontinued the product or had a recall or something awful. Like, or like even like they're diluting themselves with new shares. Like, there's no change in news. The market might be in an overall correction. Like there might be like a 5% bad week in the S&P, and like there's this correlation there. Like it's not going to do well if the market's not doing well. Like, so I try and stay level-headed. I might even buy more. It's you have to realize that like 5 to 10% corrections happen, even 20%, and like in those situations, it's good to reevaluate and take stock of where you are. Like, has the fundamentals changed? What's in the news? What are analysts saying? Okay, analysts are saying some bad stuff. It's down 20%. Is it really going to go down another 20%? Should I maybe sell? Or like, it's already down 20%. This is getting pretty beaten up. It's been a great stock for me. Maybe I'll even add more. Like it's just good to know if nothing has changed fundamentally and nothing in like in the news is like making it like, a cautionary tale. Like it might be a good time to add. So I think just like realizing that those 10 to even 20% drops are going to happen and trying to limit it at that is like, that's just part of the game. Like you have to be able to have the stomach for that, and a lot of people don't. And then if you don't, then you probably should just buy an index fund, because even at that point, maybe, I mean, in a given year, it's pretty common for the S&P to drop like 5% like in like a month. Like it's pretty common. Like you will see drawdowns, but like if you take stock of the year, like over the past 10 years, the S&P and 500 has been up like 10% on average. Even last year, the market was down 37% in like 6 weeks. It was ridiculous. I would have been losing my marbles. But you look at the S&P, like in that month, you're like, wow, this thing is down 37%. I am lost 37% of my capital. If you look at the year overall, it was up like 20%. So you're like, all right, like I did fine. So you just have to have that view that things will most likely get better. Most of these companies, if you're doing your work, will not fail, and that corrections can be opportunities. So
I think you're so right. And sometimes the same thing does happen to me. It happens to everyone. Sometimes you'll buy into a stock, and the first thing that happens, like literally the second you put that money, the second you click buy, it goes down 10%. And you're just like, how is this even possible? Like, am I being punked? Is someone like watching me? Like, literally the first thing that happens is it drops 10%. So what I try to do is, like you said, I start going back through the company. I'll start reading the 10K, I'll read the 10Q again. I'm like, am I missing anything? Like, did I just overlook something? Is there any news out about this company? Did it drop for some odd reason that I'm not aware of? And a lot of times what I find is it really leads to, I guess, higher conviction, you could say, because you're essentially doing all your research work again. And I like to look at it as maybe you're studying for an exam. You go through all the material once, you might feel confident, but if you go through it again, you're going to feel even more confident. And that's what I try to do. And I think it's good to do that every now and then for all the companies you own, just to make sure you're not missing anything. All your T's are crossed, all your I's are dotted, and you're really just on point with your investments and where you're putting your money.
You know what? This might be a little bit much. Like, I wouldn't recommend that anyone do this. Like, I'm kind of I'm a neurotic personality, but for me, I have indicators set where, like, if my stock, like, if one of the stocks I own moves more than 5% in a day, I'll look at the reason. Like, if something, if I have alerts on every holding of mine, and if it moves like 5% up or more than 5% down on a given day, I'll be like, all right, what's happening? Like, is it just like, is there something, like, I'll start at the markets, I'll start from the top down, and then if it's like something like in the industry, or if it's like something like specific to the firm, I want to know. And if it's no news, and I'm like, all right, like, then, like, you know, maybe I'm down like 6%, but I'm cool with it, like, whatever. Like, I think it's good, like, if you see something abnormal in one of your holdings, you want to know why. Like, you want to keep up with it. And, like, I don't look at it like in a way where, oh my god, I gotta manage this, I gotta, like, buy and sell. Like, I look at it more to understand, like, what is moving this stock and what will move it in the future, and where can I capitalize on those opportunities, where can dips be bought, where can, you know, what type of things are in the pipeline for that company, and just go from there. Because I think, you know, if you're doing your work and things are moving a lot, you might want to know why. That's, I mean, just for me. I mean, 5% might be a little too little, but, like, I mean, it's good to know, like, why things are moving, and, like, if there's, like, a certain, like, news event, or it's just good to have a bearing of, like, where your stocks are now relative to when you purchase them, and to always keep up with the industry. Like, I would never just buy something and, like, buy it and set it, like, be like, okay, I'm done researching this company. Like, you have to continually be willing to see what they're doing and how they're innovating, and that's a lot of time, and, like, a lot of people don't have time for that, and that's why, like, they'll just have a 401k, which is a completely viable option too.
I don't even think that. I think everyone should do that picks individual stocks. I think everyone should always be keeping up to date with the companies they own, because it's your money. You worked hard for that money, and you want that money to work for you, so you have to make sure the money is doing its job. I also think when you see those 5 to 6, 10% dips and the fundamentals haven't changed, I think that's a great opportunity to pick up more shares. Like, every stock I buy, I'm like, please go down. Please go down. Every time. Because it just gives you an opportunity to pick up shares for cheaper. And if you loved that company and the market cap was 5 billion, 10 billion, 20 billion, and it goes down from 20 billion to 10 billion, it just makes sense to buy more at the end of the day. And that every stock I buy, I'm like, please either go down and stay there for years. I'm completely fine with that, because it just gives me an opportunity to raise more capital and pick up more shares of a company I love, because I know over the long term, it's just going to make me money at the end of the day.
Exactly. I mean, there are times where I've had a stock go down like 20%, and I've looked in the news, and they're selling 500 million more shares. Now that might concern me a little bit. Like, there are things like, or I don't know, like, their CEO is being replaced, or like
that's a big one.
Yeah, like, if there are certain things that stand out to you as cautionary, it might. I try not to sell. I try to hold on to things, but there have been times where, like, I don't know, like, I've purchased something, the CEO's changed, they're selling more shares, which is diluting the market cap. I'm like, all right, this, you know, we're already down 10%. I don't want to be down 50%. Like, I'll cut it. And you know what? Like, if it goes up after the fact, I've made a mistake. But more often than not, if things have changed that materially, it's probably better not to ride out that drawdown. Like, there was actually one that I cut, and it rode down like 30% more after I cut it. So I was like, all right, thank God. But yeah, I think it's better to, like, if something materially changes, you wanna have some caution, and maybe look to trim just in those situations. But if nothing has materially changed, it's probably best to just look for more opportunities to add.
Yeah, I completely agree to an extent. I really think like if a stock goes down 50%, then maybe either A, it's a really great buying opportunity and Wall Street does not know it's coming for that stock, or B, maybe you were just wrong at the end of the day. I think that's how I look at it.
No, exactly. I mean, I think it's perfect. Like, it's an industry where you have to be willing to adapt. Like, you can't be so narrow in your views. Like, oh, I was right. Like, the industry, like everybody else is wrong. This stock is going down 50%, and you know, it's gonna, like, I'm the right one. Like, you have to realize, like, all right, if it's going down that much, and analysts are all changing their projections, the CEO is leaving. Like, you have to be like, all right, I could have been wrong. Like, I should probably move on.
Well, you also got to remember, analysts mainly have short-term mindsets, and analysts usually look like 6 to 12 months out. So a lot of positions they might be trimming, it's because there may have been something that happened short term that's going to affect maybe the next quarter, and that's their concern. But they might not understand that this company is going to 2x, 3x over the next 18 to 24 months. That's how I look at it, at least, because I really feel like Wall Street analysts think too short-term minded. And I think that's why, like, retail investors like you and I, we have a big leg up on Wall Street, and people don't understand that. And that's probably why people are not successful in picking individual stocks, because they'll see something on CNBC and it just says like, oh, sell, sell, sell because of A, B, and C. So they'll just get out of the company, when in reality, it's just, 2 steps back to take 3 steps forward.
Yeah, no, I agree. And I think it's important to, like, filter your news. Like, I think CNBC is, like, perfectly fine for, like I'm not a CNBC hater, but I think, like,
I hate CNBC.
Yeah, I'm not. I didn't want to trash.
I'm not a fan of it. Way too mainstream. Way too biased.
I would say if you're getting all your news from CNBC, you probably should reevaluate. Like, I think it's important to, like, I think it's important to challenge your biases. Like, I think it's like, if you have such positive conviction on a stock, look for what, like, the negative feedback is.
Oh, that's very important.
Yeah.
In everything you do in life, not just the stock market, everything.
Yeah, like, look for, like, okay, I love Apple, but, like, I don't know, like, so-and-so might hate it. Why do they hate it? Do they have a valid reason? That's something that might have to be on my radar. Like, that might be something, like Apple's not the greatest example, but, like, like some, like, a random stock, like, that might be something I want on my radar, because, like, they could be right. Like, you never know. Like,
I think that's so important to do in life, in everything, like politics, stocks, like money, like fitness, really everything, because you never know what you're missing out on. I see so many people that I'll bring an idea up to them, whether it's money related or maybe in the rare case it's politics, and they just shoot it down immediately. They won't even listen. They won't even let me finish my sentence. They're just saying I'm wrong and I don't know what I'm talking about. I'm just like, that's the reason why your success is always going to lag, because you can't be open-minded about anything. And I talked about this in a recent video. I'll never turn an opportunity down for someone to really give me a thesis about whatever the topic is. I'll never do it, because I've heard some of the stupidest things, some of the dumbest things have come across my desk, have been said to me, and I'm like, this guy has no idea what he's talking about. I've gone and looked into that. He's a genius. Like, it's happened to me several times, so I will never, ever turn opportunity down. Now, there's a difference between something that's very unrealistic and something that has potential, because sometimes you can tell someone throws an idea out there at you and haven't done any research at all. They're just like blowing smoke. But then some people, they give you all these points and you're like, that doesn't sound right, but it is right. You just hadn't heard of it. And it provides a whole different side of the story.
No, for sure. I think it's good to check your biases at the door. I think it's good to, like, gauge what the sentiment is, take your own view on it, and then, like, look for the opposing view, because you're never going to have the full side if you just stick to your positive bias. Like, you can't just have, like, confirmation bias. Like, you need to know what all sides of the picture are. It's your capital, it's your time. You don't want to waste it.
Right, absolutely. But Garrett, this was a lot of fun, man. Thanks so much for coming on, and maybe sometime we can have you on again sometime. But it was nice catching up with you and hearing about your history and how you went from URI to being at CFA.
Awesome. Yeah, thanks a lot, Josh. I appreciate it. I hope I could add some value here, and I look forward to speaking soon. So thanks, everybody.
Yeah, dude, for sure. All Garrett's information will be linked in the description box down below. Like, subscribe, comment as always, guys, and I'll see you guys in the next one.